an interesting vibe around the markets and the economy right now, and it's very split. There's some very good things and some very bad things happening at the exact same time, but it's happening in a way that we're not feeling it, or most people aren't even noticing yet. And I think that's just fascinating. But I want to start with interest rates. Yesterday, the Federal Reserve held the rates steady. This steady line down here is actually where the Fed funds rate is. And they've been holding it steady for a while. They did change yesterday, saying that instead of 2 or 3 rate cuts, it's probably going to be more like 1. I think it might be 0. Although, looking at this chart, if you compare the Fed funds rate to the 2-year Treasury, there's some great work that's been done on this, showing that the Fed funds rate really should just be the 2-year Treasury. They wouldn't be behind the curve, right? Treasury went up here. They were late to raise rates. Back here, they were late to lower rates when they should have, and they should have really raised it through here. You see the same thing back over the past 20, 30 years, that the 2-year rate is probably where rates should be. So based on that, the rates should be coming down, and they probably should start to lower sooner than later. But that's just an interesting way to look at it. It seemed to be positive on the day of the Fed announcement on Wednesday. Yesterday was a good day, and then today is a little bit questionable. So hard to say how that's going to play out, but I think theoretically the Fed should be lowering rates in the near future. That's just they're already behind doing it. They really should have been doing it about a year ago, from what it looks like here. Seasonality, June, we expected June to be up for the first half. We're now right around the midpoint, and it's very possible, at least historically over the past 96 years during election years specifically, the market tends to have a little bit of a rough second half of June. But the way the market's been acting, I'm not really too concerned about that. We might have a little pullback, and that's possible. But what I'm really kind of excited about is this July-August run. And that's pretty consistent across many, many time frames and many different environments. So if we can get through June and reasonably safe, we should have a good next couple of months before we get into the typical September, October, and then, election season. And then it's kind of who knows what happens at that point. But to that end, we kind of already know what's going to happen either way, at least what policy will be. So I don't think it's going to be that much of a surprise. I think that's where I think some people are underestimating, what we already know, because the market just typically will move crazily on things it doesn't know or surprises. But when it's things we already know, movements tend to be quite a bit less. Here's to speak to the split between the market, right? QQQ and NASDAQ. So S&P and NASDAQ here, green all the way across the top. There's nothing wrong with those two indexes. They're all doing very well. Apple finally woke up. It's been down year to date as of about a month ago, and now it's doing great again. International grouped index that I like to look at is doing positive. It's doing all right. AOR is a balanced index. But then you start at the Dow, and no, we're just like reds and oranges all the way down to the bottom here, and there's a problem. And ILF, which is Latin America, is basically trending down, even though it's up a little bit today. The trend is not positive. So we're very, very split. Small cap, emerging markets. Japan was good a couple months ago, and now it's not. Small cap. International AFA is just the developed markets, and then China. So most of the world has somehow gotten in a bad place fairly quickly over the past couple of weeks, but these things stay strong, and we're still holding the S&P and the NASDAQ. There's really not much else to hold because it's so messy. And in some cases, we're actually holding an inverse Dow, shorting the Dow, because that's just weak. I'm not sure why. It's kind of fascinating to watch the S&P and NASDAQ creep up and up and up while it just can't seem to go anywhere. So we'll have to see. But some of these indexes are not up year to date, and that's really fascinating to me, while these other two are doing fine. I showed you how I think this will play out for the rest of the year. All right, to dive into our data real quick, our long-term trend is actually pretty good. We're right at the midline, but the 21 line, it's a 1 month versus a 3 month, and it's actually, trend is fine. It's holding. Every time it pulls back, we come down to this 50-day, 55-day, I believe it is. That's the trend is fine. So this would back up. We could have a pullback to this blue line, and then we would have that great run July, August, as we're thinking. It's the setup is there. I'd love to see it play out. Money flow is actually not that great, and I think this speaks to how the broad market is not strong right now. Right, since about a month ago, money flow went down to below 200, and this is really a key. When it's this weak, then we have a problem, right? Back here, it's up. It's not super strong up, but when you hit these breakouts on both sides, you get a good run in both directions. Now, we really haven't had a bad run here. It's been very split, but money flow is not really backing up being super aggressive at this moment. So we're in a place because the S&P and NASDAQ are doing so well, we are quick to cut them off if anything happens. But for the moment, they want to go, so let them go. Last month versus this month on the leadership, NASDAQ is still the leader. It hadn't been as a while. We switched back to large from small, back to NASDAQ from small. So that means growth right here, growth over value. We've gone back to that. The leverage versus unleveraged is still beating itself in the S&P and NASDAQ. But of course, those are the two strong indexes, so that makes sense. This doesn't speak to the rest of the market, but at least for these two, holding them right now makes sense. There's really no reason not to be fighting that. And growth back in the leadership. When growth is leading, the market should be doing okay. So the sectors, we've got 8 to 3. I think that's actually shifted back to 6 or 7 positive this morning because I know we're selling off a little bit, nothing crazy. Well, it depends on the market again. Energy, financials, and basic materials are the weakest. Consumer discretionary should be doing well as a defensive, but it's just not. Utilities, same. They were having a great run, and they really have just kind of fallen apart. When utilities are beating the S&P, it's worth noting because that's usually not the best environment, but it is coming to the S&P leading again. And tech is really where it's at. That's really where this entire jump is. I think largely has to do with NVIDIA and Apple. Really, and that's it. There's not a whole lot else moving out there right now, but that's what's driving this leadership right here and why we're seeing the S&P and NASDAQ do so well, because there's such big holdings of those indexes. The rotation actually looks like we should be peaking up again after this kind of choppy meh. Money flows underwhelming, but these are all turning positive, or they could be. So potential strength here. I could also see this rolling over for that second half of this month, and then we get a great run. I'd love to see these shoot up into blue out of this area, not out of here. That's just for me, it's a bigger expected move if we see that happening. So that's my hope in the future. But it's bad, but it's not terrible. Is kind of how we're looking at it. And then finally, I want to look at VIX term structure. This is the volatility of the S&P measured by VIX futures. The VIX is just a volatility index looking at the movement of the S&P. It projects out month to month what the expected volatility is each month. Well, surprise, surprise, October, and then 30 days after that is the election. They're expecting more volatility. But actually, this used to be quite a bit higher, and it's coming down. So a more flat line just going consistently up is a very typical environment, but getting the spike, not unexpected, to see some more volatility get heightened into the election, but that's just to be expected. And that could change as we get closer, as we have a better feeling who's going to win. And it may not matter to some degree because we know what's going to happen. There's no surprise is the key to that.